Hi, welcome to the Dental Elite webinar, the second in our series of webinars. In this webinar, Paul and I are going to have a discussion about everything we've seen go wrong in a practice sale over the last few years. And acting on more than 120 sales a year now, there isn't a lot we haven't seen happen.
It's fun, isn't it? So many of our clients believe that us just finding them a buyer is what our function is in the practice sale, whereas the reality is, in fact one of our clients said the other day, it only represents about 10 to 20% of our actual function during a practice sale. For instance, now our sales progression team are bigger than our actual sort of practice consultancy and account management team, which is, just shows I suppose how practice sales have come on over the last few years. For instance, we I wrote a list the other day with Sue, our co-director, of everything that can go wrong in practice. It was over 100 things that we've seen over the years that have caused a sale to either falter or ultimately fail because something's just not right. And but so much of it can be prevented.
Yeah, I think you're right. I think one of the biggest challenges is actually getting the deal over the line, and that's become, particularly over the last couple of years, incredibly paramount and more challenging. And there's a whole list of things. I mean, for instance, financial accounts can be quite frustrating if they're not in order.
Yeah, because you need them to sell your practice, but actually they can cause the sale to fall over anyway.
Yeah, no, completely. I mean, one thing particularly for me is making sure that you've got purchases or expenses split out in the right way. Particularly from a buyer's point of view or a banker's point of view, or even from our point of view, actually trying to dissect what those figures mean, so you can relay that back to a buyer in a way or in a format that's understandable, can be incredibly challenging, particularly if you've got multi-sites as well, or lumped within one set of accounts.
But even just going back to the single-handed guy, there's so many single-handed guys. And my dad's self-employed. I think that's pretty much the same thing. He sticks all of his receipts in a bag, takes them off to the accountant at the end of the year, and then it's open to the accountant's interpretation as to what cost category some of those receipts fall into. Like the guy we acted for a couple of years ago, he had his purchases, or sorry, his material spend was way over 15% of his turnover, which when you look at kind of our statistics in our Goodwill survey, or indeed the NASDAQ statistics, that's enormous. And yet actually when we queried it, what had happened was he'd done exactly that. He'd taken his receipts to the accountant had seen a bill from, say, another, and had presumed that it was a material expense, whereas reality was it was the £25,000-30,000 refurbishment of a surgery.
Which actually damages the valuation quite significantly if that wasn't sort of understood from the outset.
Well, it's an extraordinary expense, and so it should be presented within the accounts as an extraordinary expense. And there's loads of extraordinary expenses from time to time. New websites is another one, pummeled into advertising and marketing, that actually people don't, it's a one-off expense.
Yeah, no, definitely. And one thing I find as well is I had one very, very recently, where the different types of vehicle that you can run a business, whether it's a sole trader or a limited company. And I've had some challenges over the last couple of years, particularly with companies where they're not treated in the same way as what a sole trader business would be. And I think sometimes the education, maybe perhaps even to the vendor or from the accountant, isn't quite understood. And the way that it's ran sometimes can cause all sorts of problems and issues depending on how you manage that cash in the business.
Yeah. Well, let's be honest. The motivation for most people incorporating a practice is tax driven. They incorporate for the purpose of tax. But what I think a lot of accountants maybe don't make clear to a lot of dentists is that actually when they do that, they're taking the business into being a separate entity. And once it's a separate entity, it needs to be treated as such. So you can't just go out on a Saturday night and withdraw a couple of £100 from the practice account, because that's its own entity. And if it is withdrawn, then it needs to be declared as a dividend or a salary or something of that ilk. And I think one of the pitfalls sometimes with limited company sales is that the vendor treats the business as if it is his personal cash flow, and actually it means the accounts can quite often be all over the place, particularly if they're using a package like QuickBooks, for argument's sake, where it doesn't necessarily present it always in the most clearest of fashions.
Yeah, you're right. I mean, I had the one last year where actually the business was sold for £1 million, and in the end I think he netted 300 grand because he'd been using the cash from the business to fund his own personal activities and wasn't declaring it. So ultimately he had drafted up a director's loan, which was well beyond what it should be, and ultimately had to pay back the money at the point of completion through a net asset adjustment, along with the tax liability that came with it, which actually meant that he netted significantly less than what he would have done if he would have treated the business slightly differently.
Yeah. Although as your guy up in the northwest, who were again practicing as a limited company, had been out and bought a load of assets, but for tax purposes had decided to treat the assets as if they were going through the business. But then when he sold his limited company, they were still assets of the business.
Oh yeah, well ultimately he had to, and that fine in that instance is he purchased the car through the accounts, and as part of the transaction had to buy the car back because ultimately the company didn't want to have an asset of a Tesla sat on their accounts. And so again, it's those things which actually you probably wouldn't even consider going before you go to market that are going to be an issue. Whereas actually when you get to it, they're probably issues at the outset of negotiations. Rather than at the later point of the deal,
or even if you've just dealt with them before sale. So if you've
Oh.
moved the car outside the limited company before you sold the business, or if you've done a couple of years, maybe, and I know some people get their accounts done for £1,200, and when your accounts are only being used for the purposes maybe of your tax bill, I can see the logic in that. But I think in the years running up to sale, if you use a dental specialist accountant, for argument's sake, okay, it's going to cost you probably double that, if not a little bit more. But if you look at the ultimate sale proceeds and what dental practices sell for now, it's really worthwhile.
Oh yeah, no, I agree completely. And I think you're right in terms of getting the right accountant and the right advice. Because one thing I've come across quite often recently is remuneration trusts and other liabilities. I don't know if I think you had one recently actually.
Well, we've got one live right now, and the issue is because obviously the law changes in April, or in fact probably has changed. And in that respect, is that there's quite heavy penalties now for being involved in a remuneration trust if the tax office decide that remuneration trust no longer works. So the problem we've got at the moment is that the limited company that we're having to sell because it holds the NHS contract was involved in a remuneration trust. And I can see the advantage of that. Jimmy Carr, Gary Barlow, list as long as your arm of celebrities that didn't want to pay any tax. So decided to put money into a remuneration trust. But the issue is that now, some sort of 10 years later, we're going to sell that limited company, and that limited company has a history of being involved in a remuneration trust. Now, in this particular deal, the actual contributions are relatively modest because actually they decided, they elected, not to be involved in the remuneration trust long term. But there are plenty of limited companies out there, and I've seen another sale somewhere else where the sale actually fell over because they put money into a remuneration trust over a period of about 9 to 10 years, which is most of their profit. So you imagine putting, say, 350,000 into a remuneration trust for 10 years, you're at 3.5 million in unpaid. Well, not even unpaid tax, 3.5 million in expenses that have gone through the accounts that the government should say weren't legitimate expenses. That's £3.5 million you should have paid tax on. But not necessarily, you should have paid tax on that 10 years ago. So then there's the interest, and then there's the fine.
I was about to say there's the additional expenses that come with that, not just the back pay of the actual tax.
Well, exactly. And then ultimately that sale failed because actually the potential liability was greater than what the sale price was going to be. So we couldn't even create an indemnity. Now, if you're in that situation, reality is you probably can't do a lot about it now, you've done it. But what you can do is realise that's going to be a problem in your sale, and you're probably going to have to take some advice and maybe even disincorporate before you come to market.
And actually from a banking point of view and a lending point of view, if you're a first time buyer or somebody that needs to go to the bank to get finance, that becomes even another issue. Even where sometimes in instances where the bank will ask you to get confirmation from the HMRC that they're aware that you're in one of these trusts, which again can open up all sorts of issues. Which I'm guessing you're not going to want as a seller.
Well, and quite understandably so as a purchaser. You don't want to buy something and then find actually you owe a couple of £1 million to the bank in 2 years' time. So it's perfectly reasonable, but actually it's something that people don't necessarily consider, that when you're selling a limited company, all of your previous affairs, be it tax related, be it employee related, all go with the sale. So you need to make sure that you thought about that, I think. And I think some of our vendors don't, is that they see the price tag that we put on the practice and they think, yeah, great, get me the magic million. But actually they haven't realised that actually there's potential liabilities that could significantly impede that.
And often not even get the deal over the line in the end.
No, sick and fail.
So there's a number of issues which obviously particularly with accounts, but there's another probably 10, 20 issues that can come up during a sale, which actually if you can sort of get clarification on before sale, then you're in a much better position.
Take associates, for example. Cool. So we had the lady, didn't we, a couple of years ago, and she came to us and she said, I want to sell my practice. So we went out, we valued it, say £500,000. She then did what a lot of our clients do, is that then she spoke to the associate and said, are you interested in buying the practice? And he said yes. But because it was just her and the associate in the business, he was delivering half the income. He turned around and said, well, yeah, but I only want to pay you £250,000 because actually half of the goodwill I already own because it's my patients. Yeah. Which actually technically isn't right. She owns the practice, she owns the entity, she owns the business. Yeah. But the problem with this particular instance is that actually he didn't have an associate contract. So that actually, when he elected that, and she elected she didn't want to accept this £250,000, is that he then up sticks and moved his goodwill to, I think it was in the same street, sort of 4 doors down. And the reality is most of his patients followed him, but they just didn't have.
There's nothing stopping him from doing that.
No, nothing.
Nothing in place.
Nothing, because in the absence of an associate contract, there is nothing. There is no covenants whatsoever.
And I'm right in saying that you can actually enforce up to 5 miles. Well, it depends on the location, but typically you have a sort of idea, some parameters. And
well, different lawyers advise different things. I think if you're in central London, obviously the mileage has got to be a closer proximity, because there's, in terms of population density and volume of practices, because of course the EU does prevent you from restricting someone's right to work.
I suppose if you're out in the outback in the middle of
the outback in Australia.
The outback Australia. If you're in the middle of Cornwall or somewhere really rural, then obviously you have to count the fact that actually there might only be 4 practices within 30 square miles.
Exactly. So you might go away with a 10-mile radius, for argument's sake. And I think that's where, again, a lot of people fall down, is they get the BDA template, and the BDA template, say, has, for argument's sake, 3 or 4 miles in it. But they look at practicing there and think, oh, well, I wouldn't want my associate practicing 5 miles away. So they change the template, they change the covenant to 10 or 15 or 20 miles. And they have this belief that even though they've heard the advice that, actually your covenants aren't enforceable if they're too wide, they have this belief that there's almost this litmus test where it can go to court and the judge can say, do you know what, 20 miles doesn't work, but I think 10 miles is fair, so I'm going to rule them out for 10 miles. But that doesn't exist. The covenant either works or it doesn't. So if 20 miles is in those contracts, in reality you probably have no covenant whatsoever.
And actually, not with associates without covenants is probably more common than you think, because particularly with perhaps the gentleman's agreement from 25 years ago, who arguably may not be in a position to be buying the practice, but where there was a handshake at the time, and that agreement's still in place, and they've never actually got a contract. And I've actually come across those more common than I think people probably think that exist.
The contracts go out of date. That's the thing, is that you can, if, for instance, even if we look at our team, for argument's sake, since we've had guys that have worked for us now for nearly 10 years, and in just the last 10 years, they've changed the rules with regard to when people retire. So I think our first contract had in it that you have to retire at the age of 65. That's now illegal. People can work for as long as they want to, and thus the contracts needed to be updated to reflect that. And in essence, that was wrong. And of course, auto enrolment's just changed as well. Is it's now 3% contribution. So actually, a lot of people have in their contracts, the stakeholder pension, which basically says you can contribute if you want to, but we're not going to contribute anything. But again, you now need to be contributing 3%. So the contracts are out of date. But from associates' perspective, the law changes, case law changes. Is that just getting them up to date is a big thing.
Well, you've got to be keeping up with the times, I suppose, and that's where you need some specialists with good contracts drafted by dental specialists who know the little nuances that are important to protect you.
Well, particularly, if you look at it from the other side, the employed versus self-employed debate, I would say, it's because a lot of hygienists who we go and see is not the hygienists, sorry, the practice we go and see, they have hygienists, and the hygienists are sometimes self-employed and sometimes employed. Now, up in the northeast, about 4 or 5 years ago, there was quite a lot of employment status investigations, and they determined on a big practice that actually their hygienists weren't self-employed, they were employees, and the risk of that is that then that in practice had to contribute all of the employer's national insurance contributions that they hadn't paid, because technically the people were self-employed.
There's actually a test you can do, I think, through HMRC's website for hygienists working in a dental practice, which tells you the likelihood of whether this person should be declared as employed or self-employed. And I had the same issue with a practice in North Wales, where I think the hygienist was working in the one practice 4 days a week, were provided with the equipment, and ultimately they declared that no, this is somebody that is classed as technically employed, not self-employed. You're providing them with the equipment, you're providing them with the hours and the patients,
and a guaranteed hourly rate.
And there's a number of nuances that you can do to make sure, and things that you can do to make sure that actually you are treating them in the right respect when it comes down to the tax point of view, because ultimately it can look ugly further on down the line if you've got a nasty tax bill to pay back 5 or 10 years worth of Tax.
Well, yeah, and I think the other point is people's lives change. So sometimes you go into a transaction and the associates want to leave because it's not a bad thing. Sometimes they're emigrating or moving to another neighbouring practice, or they want to go off and have a family, or all sorts of reasons. But actually, sometimes if you've got a particular associate who's delivering a mountain of private income, that's a real challenge, because what if that associate doesn't, the new associate, doesn't deliver the same level of income? And I think a mistake a lot of our clients make sometimes is they think, well, do you know what? I'm going to sell anyway in 3 or 4 months' time. I'll let the new guys or new regime pick the associate that they want, because it's quite a personal thing if you're going to be working with someone full time. But what happens, of course, is the income dips. So then we come along, value the practice, and we say, well, your valuation's gone down 100 grand because your income's gone down.
Well, I suppose there's two issues there, isn't there? There's income's gone down, particularly from private revenue, and then there's underperformance issues. So if you've got a dentist who was contracted to do 8,000 UDAs, and you've got, when you prorata 12,000 UDAs down over the course of the year, doing 1,000 UDAs a month, if you're two months down where you've not got an associate, or even a shorter period, then you are at risk of having not necessarily a breach, but underperforming the contract that year if you can't get an associate in time. So I suppose there's a number of angles to look at it, to make sure that you are protecting the income in that respect.
Yeah. And of course, making sure that that how the business is structured is right. Because lots of practices, who we go and see have plan patients, for argument's sake, which can be a great asset for a practice. I mean, for instance, sometimes I actually think some of the plan patients, if you've got plan patients on maintenance, paying £20 a month, that's probably better than the NHS.
Particularly if you've got a hygienist in place as well, who's doing a lot of the treatment.
But that's the challenge, though, isn't it?
Yeah.
Because the challenge is that say I'm a patient and I'm paying my £20 a month to come to the practice. So in total, over the course of the year, I'm paying £240 into the practice. And what that entitles me to is a couple of checkups and a couple of hygienes. But that, from a lot of practice, the way a lot of practices do it is that whole £240 is put onto the associate's gross, and they're paid 50% of the same. But then the question becomes, well, who pays the hygienist? And some practices do a recharge, so they would say, right, okay, well, every time one of your patients sees the hygienist, I'm going to deduct, say, I don't know, £40 from your gross. But some practices don't do anything. Or some practices make it so complicated that actually no one can actually really work out.
Understand what it is that they're...
And model it.
Exactly, completely.
But I think the bigger one, you're right, is where people just don't do anything. And so the reality is that they've got this 240 quid, they're paying the associates £120. They're then maybe probably paying the associate the hygienist up to £40 to deliver the hygiene that the associate. So actually what the practice is left with can be as little as sort of 25-30% of the plan income.
Oh, completely. And even then, if the hygienist is working with a nurse and other costs that go along with it, your margin then on that hygiene book or that plan patient becomes fairly negligible in the grand scheme of things. Whereas, and ultimately, it can be quite difficult, and again, I suppose a challenge where you're changing contracts or existing associate contracts as part of that arrangement. But it's when you bring people in.
But you don't do it on top of sale.
Yeah, of course.
If you do it a couple of years before.
And I suppose it's planning it in, to make sure that you're further, and I suppose it's the way you explain it to the associates. But ultimately, you're right. You can plan these things a couple of years in advance, rather than it being an issue later on down the line, or equally hindering your goodwill value, which is what it ultimately is going to do by possibly 20%.
Sometimes more. Well, if you imagine that you say you've got 1,000 patients, and you're paying the hygienist over the course of a year, say £60 to treat all of those 1,000 patients, then that's £60,000 in cost that you're not recovering any of it. If you were recovering £30,000 of it from the associate, then that would be £30,000 in EBITDA. £30,000 multiplied by 7.
Look at that goodwill survey. So it's a big chunk.
But it's similar though, isn't it? Because salary clinical staff, similar kind of argument. Dental therapists, salaried dentists, exactly the same thing.
And they're not recharging the right way. You're double paying. No, completely. And as you say, even though ultimately you're not, it's more the goodwill value ultimately at the end, which is affected there, isn't it? And making sure that actually from a broker's point of view that they're picking up on this early on and that it's explained, because otherwise, as you say, you come across all sorts of issues later on down the line if it's modelled in a certain way, which in effect isn't actually how you're running the practice, which can then open up all sorts of issues later on down the line.
But of course it's not just the associate hygienist, it's the staff as well. Staff and
Yeah.
it's similar kind of issues, isn't it?
Yeah,
Contracts
completely.
can be out of date, nuances in their contract. I mean, lots of people can have it that they get their birthday off, for argument's sake.
Yeah.
Great employee perk, but needs to be worked into their holiday allowance.
Yeah.
You can have it that people get private medical insurance, which obviously has a cost, which then can affect valuation.
Yeah. Bonuses, discretionary bonuses, all that sort of stuff, which isn't necessarily always in there.
Well, what people forget, I think, is that the bonus is that Christmas bonus. People think they're being and it is nice, of course. I'm not Scrooge there. Is the fact that they give out this Christmas bonus of say £200 or £300 every Christmas.
Yeah.
But because they've done it for sort of 3 or 4 or 5 years, the argument is that then it's almost become contractual. Is that the staff are then entitled to this bonus?
Yeah.
So I think again in the run up to sale, it's probably worthwhile looking at being a bit more variety in terms of how you reward your staff, so that you're not varying into territories of it being contractual.
Yeah. Yeah. No, we know, which is true, and I think that's that's an important part, particularly when you're dealing with
Lots of stuff. Yeah. But pay rises.
Pay rises.
The other one is that I think, and I can understand this because I think as and when we sell Elite, I think we'll probably want to know that the staff are going to be looked after.
Yeah.
So a lot of people give people a big pay rise before completion, and the challenge with that is, of course, that then impacts the valuation and impacts the EBITDA.
Yeah, of course.
But there's actually another way around it. Is if you give your staff a discretionary bonus at completion, you know that they're definitely going to get the benefit from it. Whereas sometimes I think in any business transition, people move on or people move out. So you could give, say Sally a 15% pay rise, but actually she may leave 3 weeks after completion anyway.
Yeah. Sure.
And what you've done is you've cost yourself that 15% in her money, multiplied by say 7 or 8 times if you're selling in your practice, and she's only going to get a month's benefit.
Yeah, no, completely. And I think when you look at it from a pre-sale point of view as well, is actually it's not about cutting down costs to the point where you run so lean that it becomes unoperational in the event that you have somebody off sick. But I suppose it's just about being smart in terms of how you recruit. And I come across actually one guy the other day, only a small practice, free surgery practice, and he's got 3 managers, all full time.
Then we get CQC manager, marketing manager,
marketing, and you kind of think, okay, great. From an operational point of view, and from his point of view, he's got a lot of cost covered, a lot of roles covered. So it means that he can get home at night and he doesn't have to worry about the CQC, he doesn't have to worry about the marketing in the practice, updating his social media page, whatever it may be. But actually 3 managers, which in effect is costing the best part of 70 grand a year, becomes a big challenging point when it actually comes to sale, particularly if you haven't got the level of income to justify it and the size of practice to justify it. Because all of a sudden your staff costs come from what an average is 17-18%, to all of a sudden have an average of 27-28%, and that's a 10% margin, where in essence it isn't probably required in that sort of type of practice. And even though we talk about figures and we talk about making sure that your practice is run lean to a certain point of view, but it's actually just making sure that you are you're running to how you need to run rather than overstaffing and overpaying, I suppose.
Yeah.
It's looking at what the market rates are.
But you need to continue delivering, like with the NHS, for argument's sake. With the NHS, you've got to deliver your contract. Is that, and I don't, I know there's schools of thought there, and we did an article about a few weeks ago about a breach notice isn't necessarily the end of the world now.
Yeah.
But what you don't want to be doing is you don't want to be knocking out 80% of your contract in the 2 years running up to sale. You really want to be bang on target.
Yeah, completely. Yeah, no, and I think that can cause a whole heap of issues. Particularly, depending, obviously, when it comes to valuations, it can be location sensitive anyway. But particularly if you've got on top of that additional breach issue notices, because all of a sudden, that's from a buyer's point of view, from the bank's point of view, you are opening a number of issues. And there are ways to probably deal with that pre-sale to avoid breach notices. Actually, we met lunch with one of our clients a couple of weeks ago who deal with underperformance slightly differently. If they almost calculate that they're going to be underperforming by 10%, is rather than taking the money and paying it back and risking that breach, they're taking the view to pay it back and rebase their contract for that contract year, which actually, in essence,
but unfortunately, not everyone can do that now, can they? Is that a lot of LOTs won't accept that.
No, true.
But of course, but you can approach it. Particularly, I think if there's periods of illness, which are illness, which are certified illnesses. Because then actually the LATs have to behave reasonably, and if you can prove that there is a medical reason why you need this temporary variation, then it makes sense to approach them. And even if you decide it's not worth the effort of having to appeal and all that jazz, if you never ask the question, you never know.
No, you never know. Yeah, and ultimately that could be the point of getting a breach and not getting a breach, which actually. if, you know, and actually breach notices are far more common now, even during transactions. I know we're talking a lot more about pre-sale, but when you look at, you know, during transactions, it's not common to go into a deal where they've had no historic breaches, and that contract year they get a breach for whatever reason. That could be for a number of issues during transaction, which we'll get on, obviously have a chat about later.
But I think sometimes people can take it too far the other way. Is sometimes they end up in a ruckus with the LAT.
Yeah.
And actually they leave themselves exposed to being the LAT's, you know, public enemy number one, and you can end up with an issue where all of a sudden you've got, you know, a practice which is under investigation. I'm not saying that investigations are led to as a result of this, but I think sometimes, particularly vital signs reports, you know, if you've got if you're an outlier on the vital signs report, the chances are you are more likely to get an NHS investigation. So, you know, a lot of people, when I go and see them, they haven't even read their vital signs reports. They don't know if they're an outlier or not. And actually, if you can adapt the practice slightly in terms of maybe the recall intervals, so that you fall more into line of the, you know, the contract or the local area averages, you're probably far more likely to swerve an NHS investigation, which ultimately could prove, you know, costly. Because when we're managing sales who are going through investigations during the sale process, often they are then bundled with extra indemnities and warranties and all of that, and you're almost having to quantify a hypothetical loss. And I think the argument there is buyers become a lot more serious about quantifying the hypothetical loss than maybe if they were in a pre-sale situation, where actually, you know, if the investigation was avoided in the first instance.
Or even just the fact that they're even under investigation. I think sometimes there's a stigma attached to it, whereas actually now they're not that uncommon. You know, the LAT are picking out, you know, various things to investigate for, whether it be note taking or, you know, various other reasons. But I find that actually they're not that uncommon, but still trying to overcome that barrier when it comes to sale is incredibly challenging and difficult. And that's been, I've had a couple of transactions recently where I've had that exact issue. Whereas actually it's a first time buyer, they've not come across, you know, ultimately they don't want to be buying a practice that's got an investigation out carrying, which is fair enough.
But going back to breach notices again, is because the other stupid thing is sometimes they can be easily avoided. You know, the argument is that obviously a lot of people signed their NHS contract in 2006, and in that contract there are opening hours, and it says in a lot of practices that like the practice should open from 9 till 5 Monday through Friday. But you know, as they've got, you know, maybe the twilight years of their career, they've dropped the Friday afternoon, but they never actually varied that with the NHS. So technically, if an NHS officer turns up when it at 3 o'clock on a Friday afternoon and the practice is shut, you're in breach.
Yeah. Well, that happened a couple of years ago, didn't it? I think to a big group.
Between Christmas and New Year.
Christmas and New Year, where they really went around the practice and checked, and actually half of them were shut. And they were in breach. And they did get issued breach as well, I think, didn't they, for that?
I think in the end it got appealed because it was deemed that the NHS were being a bit strong-handed.
Didn't quite handle it.
And they were deliberately seeking to issue breach notices as opposed to genuinely investigating something. But you're right, the principle is the same, is that if your contract says you should be open, you should be open. And actually a lot of NHS will probably just vary the contract to change the opening hours, but it's something that probably will crop up in due diligence, but might take a few months to get through the NHS, so you probably want to make sure you're doing it. The other big boy, of course, going through, you know, the pre-sale stuff is property. Is a lot of people don't give consideration to the property element of their transaction when they come to either renew their lease or in the run-up to. And I know it's a commercial argument because, you know, say you've got 4 years left on the lease, right, is that what you don't want to do is you don't want to necessarily be on the hook for another 10, 15 years. And because there may be the concern that the practice might not sell, even though the reality is there's very, very few practices which ultimately don't sell. Of course, it doesn't always, you know, go wrong pre-sale. Sometimes it can go wrong in the marketing process. And yet sometimes that can be, you know, prevented. Of course, the biggest reason why stuff doesn't sell is valuation, is if valuation's wrong. And that, you know, and often I think, and I suppose it's easy for us to say because of how we present our valuations, but I think where you have a mystical valuation that you can't justify, is it becomes very difficult to say to a purchaser, well, I think this practice is worth £282,313, and the first question is, well, why?
How and why?
And I think the reason why, you know, certainly it would seem some of the group buyers like working with Dental Elite is that they find that the way we present our prospectuses is that you can actually see in the valuation, oh, okay, you know, this is what I think the adjusted net profit is going to be, this is what I think the EBITDA is going to be, and then they can do their own math from there as to whether it's a multiple of that figure that they're prepared to pay.
Of course. And I suppose there's a number of issues during that process. It's not necessarily you may or may not find a buyer, but arguably if you're over marketing the practice then it could be difficult anyway to find a buyer. But even in the event that you do, there are other hurdles then during the process which can cause problems.
Yeah.
Such as when it comes to getting funding.
Yeah, exactly. So I think the first thing is from finding a buyer in the first place is you need that clarity. Is that where there's not clarity in the valuation or there's not clarity in the figures, then you can find yourself in a bit of a muddle, because then your purchaser starts to ask questions about the practice. And of course they're going to ask questions in due diligence, but I mean the kind of the more hypothetical kind of questions is the fact that, well, if this is not quite 100% as I thought it was, is there something else that's not 100% what it was? And then they lose faith, and if they lose faith, they lose interest, or they make lower offers.
Yeah, completely, and that is a big issue.
And I suppose it comes down to restated accounts as well, doesn't it? Because there are a few people who I know, and throughout the sale process, have restated their accounts in the previous 2 years because their accountant has, for whatever reason, made a mistake, or they've decided that actually the accruals and matching process wasn't 100% correct in terms of how they were presenting it.
Yeah.
And that's obviously a big issue sometimes as well, is that when the figures are wrong, because often a lot of non-specialist accountants will take income as the cash in. So they'll see money coming in from the NHS every month at say 27,000 or something like that. And what they don't realise is that because of the way the NHS systems work, patient charge revenue, there is roughly speaking about a 2-month lag on it.
Yeah.
And patient charge revenue in most practices I see doesn't work like that.
No.
It does this. Particularly where, of course, you've got the half terms and Easter holidays, and you see more kids and stuff like that.
Yeah.
So often it can distort the income by, sometimes as much as sort of 10%.
Yeah.
And actually, what they end up doing is either over or understating the private because they've worked the accounts on that basis.
Yeah. Yeah, and actually happens quite more often than what you think.
Yeah. It happens a lot. So I think again it goes back to what we were speaking about earlier, in the sense of the fact that if you use a specialist dental accountant for those last 2 or 3 years running up to sale, all of those issues are definitely being sorted out.
Yeah.
So that's the business valuation, but of course freehold valuation can be just as problematic.
Yeah, of course, and I think you already said it. If there's again a bit of forward planning, we'll go into it. But as long as the expectation is met when it comes down to the freehold, and ultimately it depends on how that's managed during that process. And it's often actually you can go to market where the valuation hasn't been done on the freehold, and it's a finger out the air sort of job, which actually can cause bigger issues.
Well, how many times have you heard the story of that? Oh well, Barbara died, about 6 months ago, and her house, a bungalow, which is
is worth
pretty similar to this practice.
Yeah.
That sold for £500,000,
yeah,
but we're a bit bigger,
yeah.
So I think we're probably worth 550,000. Only then to get into the valuation and find that actually it's 375,000 or 400,000 pound property.
Of course.
And the challenge with that, of course, is then actually it was only ever worth 400,000. It was never worth 500,000, because there's a big difference between commercial property and residential property valuations.
Yeah, of course. Yeah.
The other challenge is the fact that when we're valuing a business, is that we use that freehold valuation to work out what a market rent might be.
Yeah.
And if we've overstated the rent, we've understated the profit, understated the EBITDA, understated the business valuation. And then the other side of the things is the fact that, again, then you've got a vendor who's disappointed throughout the sale process. Whereas if you know from the outset, what the actual valuation is, and in truth, you need someone local to do this. You need someone local who knows the area, who knows the individual pockets of comparable data that they can pull upon in order to give you an accurate reflection. But just relying on what Barbara's property sold for 6 months ago, this isn't going to work.
And to be fair, I had a deal probably 2 or 3 years ago, which unfortunately fell out for that very reason. Is that the owner was being advised by his dad, the leasehold, so not the freehold but the lease. So equally, the vendor wanted to keep the property at the time, was going to go to lease arrangement, and had put a figure on it, and his dad had said, no, I think this is the figure that you should be going for, even though it had been explained to him that it would be subject to evaluation, and the valuation had come down significantly less, but the seller would not budge, and equally the buyer on the other side of it isn't going to pay 60% over market rate for the lease.
Or then going back to accounts again, then there's the guys who want to sell the business now in 2019 on 2016 or 2017 accounts.
Yeah, of course.
And that's not going to wash either, because is that most buyers then are going to look at that practice and say, yeah, I love it, I want to buy it, but
I want the accounts.
I want the accounts. I'll put an offer in, and by which point you'll then say 3 months down the line, and you haven't got an offer, and then buyers then start to think, well, why is this practice still on the market?
Yeah, of course. Which in fact, I've got that exact issue now, is that we're working off year-end 2017 accounts, And it's that exact issue. So he wants to go to market now, quite desperate. But I've advised that actually it's kind of counterproductive going to market, because ultimately you're only going to get the questions asked at the point, or even often not even get the viewings, because people want to see the latest figures and the latest accounts or the latest MI, rather than running on figures that were ultimately 18 months, 2 years old now.
And I suppose that's what amazes me most about having done this job now for so many years, is the fact that we take people to market who perceivably don't want to help themselves in selling the practice.
Yeah.
Is that there's almost people who go to market who are counterproductive to the sale. I mean, we've got the negative vendor, the guy who sits there on a Saturday afternoon showing people around his practice and just tells them everything that's wrong with the practice, or everything that's wrong with the NHS, and how he's glad he's going to be retiring next year because we're all doomed.
It doesn't help the sale, does it?
No, it doesn't. And then on Monday morning he says, "Where's my offer for £500,000?" Well, it's not there because you put everyone off.
Yeah, no, which is true. And that's again more common, isn't it? And it's about being able to present the practice in the right way. Ultimately, you're selling an asset, you're selling a business. You're not trying to explain to somebody why you're trying to get out, which is a lot of the time trying to find that right balance and managing those expectations from the outset, isn't it? Rather than going into it.
But there's so many characters, because then, of course, you get the gung ho vendor. The guy where he's got 8 viewings lined up, and yet the first viewing comes in and offers him, £5,000 over the asking price, and without asking a single question about their finance, asking a single question about where they're getting the money from, how quickly they're going to buy it, but they've offered him £5,000 verbally over the asking price, accepts it, and then rushes every other viewing through the practice because he thinks he sold it, only to find on Monday morning the buyer's changed his mind.
Oh yeah. Well, to be fair, I had that exact. Well, actually, this one wasn't through us, but they came back to us to sell in the end. But they had sold to a guy. How they came across this buyer, I'm not too sure, but he's quite a well-known buyer in several practices. Went into the practice and gave them a cheque for £40,000 and said, "Take the practice off the market and take this cheque, and I will give you X amount for the practice."
But wasn't it like 200 grand below the asking price?
It was significantly below the asking price, but he went in there and pressured them into taking the offer, which actually in the end, it all came about. The transaction fell through, and they instructed us at the time. We had met them in various stages. But ultimately, they felt that the offer at this time with this particular buyer.
Actually, think there's someone who's actually got a testimonial on our website now.
I think
strangely,
it is. Yeah. Oh, yeah. No, it is. Yeah. We have actually got the testimonial, but they achieved more. We achieved a better price, and fair enough. The deal didn't go through in the 2 months that the previous buyer had promised them, because ultimately transactions don't go through in 2 months' time. They take 6 to 9 months, and that's just the way that it is. But he sold them on the false promise that he was going to get the deal done in 2 months. Here's 40 grand. They flashed the cash. He thought, okay, great. This, how can I turn? It sounds too good to be true.
I don't know what's worse. Is it worse having people like that, or then the guys who are so indecisive? For instance, we know now is the fact the market has shifted in the last couple of years, and there's some practices which we could take to market and we could sell. In 4 to 5 weeks, which is the shortest marketing timescale we advise. There are some people who are on the market for 6 to 7 months, and then they get an offer. Say they're practiced on the market for 440 grand, they get an offer at 430,000. Which is a pretty competitive offer when you've been sitting around that, and then they take weeks to think about it. Yeah. And I've obviously sold a number of houses now, and you sit there and you think, when someone made me an offer for my house, is that I knew I wanted to move, I knew I wanted to be on that next step in my personal life. So the taking a small reduction just to get the wheels in motion was worthwhile. But even if it's not, I made a decision. But it's the guys who then take 3 or 4 weeks to accept an offer. We've got one live at the moment. Outside over in Ireland, and it's a practice we've been marketing for a considerable period of time. Who's got an asking price offer, and yet now he wants 3 or 4 weeks to think about it.
And do you think that comes down to that sort of emotive decision making behind it? Is that it's not necessarily looking at it from a commercial point of view. There's too much emotion involved, or there's something else there.
I think you're bang on the money, but that can also work against them as well. Is that again, I know you've had loads because we've discussed it, in the sense of the fact that you get the guys who do their viewings and they get 3 or 4 asking price offers, and they go with the guy who they liked at the viewing. Which is there's nothing wrong with that, and to be in truth, I would probably make a similar kind of decision. But I think what people need to be aware of is the fact that actually these buyers are often really experienced buyers now. They are salesmen to a certain extent, so they're going into a practice and they're selling themselves. In fact, I had a conversation with a vendor we've got live yesterday, and they said, oh, you know, how long should my viewing slots be? And we agreed on a time. And what the lady said was, she said, because what I find is the fact that some people just come in and talk and talk and talk and talk and talk, because they take the view that the longer they talk to me for, the more likely I am to accept their offer. And actually, that's not how I want to be. I mean, this vendor is particularly commercial. But I think, you know, the guys who make decisions emotively, you know, sometimes maybe they'll take a lower offer because it's from someone who came across really well at the viewing. Is you want to make sure you know who that buyer is if they're totally new to you, because actually sometimes, you know, there's what is a wolf in sheep's clothing, isn't it? I think is the expression that they use.
And to be fair, that is exactly what happened with a deal I had last year, which actually is completed now. But at the time, they were happy to take the offer at the viewing. And basically on that basis, they said, you know, a really nice guy, you know, talk the talk. And ultimately for them, you know, they felt that they were the right buyer. But from our point of view, when you looked at the mix of the buyers that were looking at the practice and reviewing and that were offering at the time, is that they weren't the strongest buyer. You know, by far there was actually somebody far stronger. And you know, and even though we had outlaid the potential concerns of the buyer, ultimately every buyer's going to have a slightly different position. But you know, when we sort of outlined the pros and the cons of each buyer, because that's ultimately a big part of what we do. You know, it almost wasn't taken into consideration that actually there may be more issues further down the line based on historic history working with that.
But then there's some people who don't even let people through the door.
No,
they make viewings really hard to get. You know, and actually you sit there and you think, do you actually want to sell your business? Because if we can't get people through the door to sell the practice, and some people don't do it deliberately. You know, I now make a point of asking all my guys before we put them on the market of the fact that what is your availability over the coming 2 or 3 weeks? Because there is no point in putting a practice on the market. You know, the vendor then being away for 2 to 3 weeks on holiday
loses momentum,
and the practice sale loses momentum. Because by that point, again, you get buyers questioning why a practice hasn't sold. But the reality is the vendor just wasn't available. But you know, I think sometimes the timing of marketing a practice needs to be given a lot of consideration.
I think timing is crucial, and I think, as you say, if you can manage to bunch up viewings in order to try and orchestrate a timeline, you're much more likely to get a speedier deal agreed than where you've got sort of pockets of viewings that are happening. The vendor goes on holiday, and then you almost put in a stray viewing on a Friday afternoon, and then somebody else comes in, I want to view next Tuesday, and it's sort of, you want to
also if you get an offer,
making sure,
because sometimes let's say you're going off on holiday, so you get your viewing in on the Friday, you get an offer 20 grand below asking price, which you may be wanting to accept, but you've got another 6 people lined up. Now your risk is that if you're away for a couple of weeks, you're not going to see those 6 people for that fortnight, but you've got your offer sat there wondering why it's not going to be accepted, so you run the risk of losing your offer. You've got to gamble in essence. It's a bit like game of roulette. You know, do I take the offer that's on the table, or do I wait and see my other 6 in the hope I get an offer? Whereas actually, if you're just around, it makes sense. A lot easier.
Yeah, I mean, to be fair, I've got a deal at the moment actually, which is quite refreshing from the vendor's point of view. Is that we had interest, we had an offer on the table from the first viewing, but we had 3 or 4 people that came through that were interested in viewing, and the vendor was like, no, I'm sticking to my guns, quite happy, we've had 3 or 4 good offers, we'll stick with it and we'll keep up the momentum. And in the end, actually, we agreed a quicker deal. Ultimately, we're not everyone's best friends from the buyer's point of view when it comes to that, but it respects the vendor's decision.
Exactly, but I think if you can be open with your buyers and give them a firm process. So obviously the process we work with is that if we've got multiple interest in a practice and we get a competitive offer, then we will put a bidding deadline in place. And that bidding deadline is normally some 2 or 3 weeks in advance, so that then a buyer knows when they're going to get an outcome from their offer. And there's still an outside risk that you may lose the buyer in the interim. But my view is that in that 2 or 3 week period, they probably won't have committed fully in their hearts to the practice. So if something better comes along, they would have walked anyway in that 2 or 3 week period. Whereas I think if you can say to them, look, here's a deadline when you're definitely going to get an offer accepted, it also brings all the other offers into line, so you don't find yourself in a situation where you're sat waiting for because someone's promised you an offer, you've already got one on the table, you've given them a deadline and said, if I get my offer, you get your offer.
Everyone knows where they are.
So I mean that's quite cool. But of course, then you can also get people who the amount of times people don't want to go to market yet because they're busy tarting up the practice. So the guys who present this attractive facade, so they're painting them waiting room magnolia and all this kind of stuff, but they're missing the key fundamentals of what a buyer looks for in a viewing. A buyer wants to see a busy appointment book. So again, if the idea is the fact that the hygienist appointment book looks gappy, well, why does it look gappy? Oh, it's because actually the associate's been off on holiday for 2 or 3 weeks, who hasn't sent the referrals.
The more important stuff is the income and the gross, isn't it?
Yeah.
Not the shade of magnolia that you got, or the. But equally, yes, you do want to make a practice attractive and saleable. But it's, ultimately everyone's got their own taste.
Yeah.
So if you go sitting there putting lavender walls all over the place and trying to give it a nice spruce, ultimately you run the risk of make it unattractive.
Yeah. So I would focus on the appointment book. Get your appointment book busy. Show that there is a good, solid run rate. That you're booked into the next week. That you're not sat there on a Monday morning wondering if you're going to have a 4 o'clock in. Is you really want your team focusing on that appointment book, not focusing on the colour of the waiting room.
So I think there's quite a few things that you can probably do to prevent issues actually during the transaction process. So once you've actually found a buyer, there are probably things that you can do in order to make sure the next process is run.
Well, I think
smoother.
Head to terms is one, isn't it?
Yeah.
Because we worked out that our number of abortive deals in the absence of a head to terms was significantly higher than where you had deals that were progressing with head to terms.
Yeah.
And I think a lot of that is twofold. I think first of all is if you're getting heads of terms and you're getting in a lot of cases a deposit, you'll know that your buyer is definitely committed because they're actually having to put some money on the line.
Yeah.
And the second thing is encourages people to talk about the big commercial issues before you get involved in a transaction. And at that point, I think people are far more, for lack of a better expression, in love with a transaction, is they want it to happen.
Yeah.
Whereas I think you start debating a big commercial issue 5 months down the line, sometimes you can end up in a situation where actually you haven't got the same connection with a deal as to what you would have wanted.
Yeah, and I think you're right. I think that's the nail on the head. It's getting those big points agreed in the outset. So you're almost covering them in the first couple of weeks of negotiating the heads of terms.
Yeah.
So hopefully when they crop up, or if they crop up, that they've got a clause there which gears you in the right direction in the event that happens.
Yeah.
But actually it's in black and white. It's a lot easier to manage.
But I think the challenge is why sometimes they don't get agreed, or then someone attempts to renegotiate them later on, is that they don't have all the stakeholders on board, or no, they aren't taking advice from the stakeholders at the outset, and it creates lots and lots of challenges. So for instance, to focus on accountants for a second, is big thing with limited companies is it is tax advantageous to leave the cash in the limited company rather than extract it as dividend and pay personal tax on it. Is that ultimately, as it stands at the moment, is if you go on to sell the practice with the cash intact, is that the enhanced purchase price, by virtue of the fact you have additional cash, and after net asset value adjustment, means that you're going to pay 10% tax in real terms on that cash, and then you've got that cash in your hand. Whereas if you withdraw it as dividend, it's like 37.5%. So the amount's massive. Now, from a purchaser perspective, is that only going to cost them 0.5% in stamp duty, which normally you can see by virtue of a slightly reduced agreed sale price.
Yeah.
But I think the challenge sometimes is that if people aren't getting the right advice, they actually think they've got to find this £500,000 extra to pay for the practice.
Yeah.
And then you end up with buyers saying they can't afford it. But actually, it's just paper chasing.
Yeah.
And if you get a good accountant who understands net asset value, it's an easy negotiation. If you get an accountant who doesn't understand net asset valuation, and I suppose that's been my biggest surprise over the last sort of 6 or 7 years as we've had more corporate transactions, is the amount of accountants who do not understand NAV.
Yeah,
which is
quite surprising.
It's astounding.
You come across more solicitors that understand it than you do accountants a lot of the time.
Exactly. It's astounding how many people don't understand NAV, and yet actually it's such a simple principle of paper chasing money around. If it's done badly, it can cost vendor or buyer a humongous amount of money, which it doesn't necessarily need to do. Because the other one accounts as apportionments. Now, obviously, that's always a big debating point. Vendor wants it one way, buyer wants it another way. But what you don't want to do is have that dispute 4 months in transaction, and normally it's a dispute where the accountant is advising the respective parties. So you've got to take that advice early on.
You've got to take the advice early on, and I think also I think it's important to get somebody that's got a commercial view on it. I think sometimes is that ultimately, as you said, the seller wants it one way because he doesn't want to pay income tax on it. The buyer wants it another way because he can depreciate on it longer term under his tenure. But arguably, there's a middle ground, and I find it's about finding that middle ground rather than necessarily saying, well, I don't want any apportionment this way, I don't want any apportionment that way.
But I think
It's about finding
sometimes
the balance.
people have the temptation of the fact that, and a lot of solicitors I think are sometimes guilty of this, is saying, oh, well, we'll deal with that later. We'll part the issue, we'll deal with it later.
And it doesn't get dealt with.
But everyone knows everything in life is that if you park an issue, invariably it comes back and bites you on the backside. So just get it sorted.
No, I agree, and that comes down to also the staying on terms as well, because obviously in our letters of terms we have various clauses in there which cover, your staying on package, if you're going to stay on for a long period of time, the period, and equally lease arrangements and bits and pieces as well, which actually, covered early on, prevents bigger issues later on down the line. Even though they're only small sort of deals, sort of points, but equally if they're not discussed at the outset, or aren't discussed at any point of the transaction until later on when it comes to the associate agreement, and all of a sudden you've got a whole load of other issues which actually, could have been prevented by going 5 months into the transaction, which then could equally abort as a result of it.
Yeah.
So you're much better off doing it from the outset rather than getting 5 months in and everyone's incurred costs.
No, I think you're right, and I think that the is often as well what the heads of terms draws people's attention to is the buying vehicle, and this is a big one, because again, lots of people think they don't see the urgency in it, but actually because of what happens with the CQC now and the CQC registration process, is we need to make sure that we're registering the right entities with the CQC. So if as a purchaser, and again, Sue was saying she has this issue a lot, they turn around 6 weeks before completion because they've taken some advice from their accountant and they need to buy the business using a limited company. The reality is that the bank's then got to redo a load of paperwork and probably send it back to credit. But probably the most timely of issues is the fact that actually that entity, because it's going to be providing clinical services to the public, has got to be registered with the CQC.
Yeah.
And the CQC KPI now, that you're probably talking 3 months, 4 months sometimes.
Yeah, if it's not right.
Which can be a big delay at the back end of the transaction. Just because someone didn't take advice at the outset of the transaction.
So the running theme really is that it's certainly getting key advice and making sure you've got the right stakeholders involved early on in the transaction to make sure that you're giving the right advice and that the crucial points of the transaction are outlined and everyone is in agreement. Right? Exactly,
and there's nothing worse. And also I think what the heads of terms does flush out is whether someone's going to be getting really poor advice.
Yeah.
And actually having really poor advisors is a massive headache in transactions, and often I don't think vendors necessarily get the temptation is I think that someone quotes you, will quote you may, or you get a quote for £4,000 plus VAT and everyone else is quoting say 8, 9, 10 grand plus VAT. Now the first thing I would question is that why can someone do the job for 4,000 yet someone else wants double the money?
Yeah, certainly,
And the resounding outcome is normally that the person who's offered to do it for £4,000 either is probably not an experienced dental specialist, or they are a law firm which relies on the other side doing the work. And the problem is when you get that is that then when the documents come through and the documents come back off is you end up in a situation where actually they're not being reviewed properly. So there's elements within the documents and warranties and indemnities that are either being given or asked for which aren't appropriate indemnity warranties, which again are going to come back and bite you on the backside. And of course then you have pace issues with poor advisors. You have solicitors who just drag everything down to really, really slowly. And then you have other solicitors who just want to seem to pick a fight. Which I suppose is actually probably one of the more common issues that you come across where it does become point scoring a lot of the time. And you do get the sense of there's no massive incentive for the deal to be able to get the deal over the line. And I think that's where obviously it's important from our point of view, to make sure that the tranches that all sort of lead to completion are sort of managed and handled and chased through and followed through in that respect. Because you've got, as you quite rightly said, you can get wrapped up in points which actually can hold back a deal for the sake of £300-400 indemnity, or an undertaking which actually could have quite easily been resolved with a conversation. Well, essentially last week we've got a £3 million deal at the moment who are arguing about £500.
Whereas if that was outlined at the outset, we don't know obviously what that was, but arguably where it becomes to reassignments of leases and bits and pieces of who bears the cost. And actually, if you outline that at the outset again, you're in a better position, or rather than arguing the sake over £500, which often, as you quite rightly said, is that solicitors can argue that point rather than say, do you know what, take a commercial view and it's £500, doesn't really matter either way, let's just crack on with the transaction.
But I suppose the other point I've made, which some might argue is controversial, is that there are people who are dental specialists who are people we wouldn't advise people use. because just being a dental specialist and even being a known dental specialist doesn't necessarily mean to say that they are good commercial solicitors. And I think that's why, you know, irrespective of whether you're using us as an agent or whether you're using someone else, is that actually, you know, talk to them about who you're intending on instructing, because when you do lots of transactions you get a feel for the guys who are quite happy to let something sit on a desk for 2 or 3 months against the guys who actually really want to push transactions through.
And equally offer the right advice. And I had one probably a couple of years ago now where there was a lease issue, and the actual solicitor on the other side was a dental solicitor, had done dental transactions, but was advising the buyer at the time, who was going to enter into a leasehold arrangement, but he wanted the company to hold the lease without a guarantee, and that became a massive issue. Whereas the solicitor was advising that he didn't become a guarantee on this limited company, which is the NUCO, no previous history. Well, that was poor advice, and the transaction fell over because of that reason. If they had got anybody else who was a little bit more commercially savvy in the typical arrangement, when it comes to looking at leases, I think we probably would have that deal would have been very different.
Well, I think the other thing that's interesting is the fact that obviously we manage the CQC and all of the transactions that we do, and we've been doing this for years now. We actually have a CQC department, and you know, a couple of ladies that do that process work. So it's not just a case of us sending out the forms and filling it in. We properly hound applications, and it's interesting how that's popular with some legal advisors, and with others it's not. But I was chatting to Helen the other day, and the pattern seems to be is the advisors who don't want us to do it realise that the reason why is because actually then it means we dictate a timeline, or do we dictate a process timeline, and what it does is it puts them under pressure to ensure that actually, you know, they are going to turn around the SPA and the ancillary documents within a given period of time, rather than you know, them setting the timeline and saying, oh well, it's pointless doing this yet because the CQC hasn't been submitted. Because the other aspect of CQC is the amount of people that get the wrong DBSs, and even though we tell them, you know, I had another one last week where I can count the 3 emails I've sent them and the telephone conversation I've had with them, where I said, look, you need to get a CQC countersigned DBS, and yet still they went online and got a DBS for someone who said they could do it in 4 days. And the problem is, of course, the documents. The documents look identical bar the top right hand corner. So people genuinely look at it in a quick flash and think, oh, it's the same thing. But of course, it gets thrown back out. Or people who, you know, when they get their DBS in the first instance, they only tick that they're going to work with adults rather than the whole population. So then we have someone submitting a CQC, and the problem is that doesn't necessarily always show on the DBS certificate. Is that they submit a CQC application saying they're going to work with the whole population, but actually what their DBS permits them to do is only work with adults, which then again means that the CQC gets thrown out, and we have to go right back to the beginning to get that DBS, which again can have weeks and months onto a transaction.
Yeah, well, I had one very recently which they did delay by about 8 weeks in the end. So it's important to make sure you're getting the right DBS. And I suppose that's why, from our point of view, having that in-house, that does allow us to sort of control it usually and check it before going out. And often what I have found is where the issue comes where that's done by another third party, and it hasn't been picked up. Whereas actually if it's picked up without the application going in, again, you're saving time.
But of course, finance, another big bugbear. You know, as you go through the transaction, you know, people who don't choose their bank quickly or haven't done enough research at the outset, or perhaps I think the biggest flaw is where people have a pre-existing relationship with a bank, and so they're looking around for practice. They approach another bank and they say, yeah, I'm happy to lend money, and then they get, which is true. So then they place their offer with proof of finance from a given bank, but then they decide to start doing their shopping around, whereas actually, having had a full credit backed offer, which took them 3 or 4 weeks to get in the first place. Now the issue with that is that the CQC is running on in the background, and you may still be saying 3-4 months away from completion. So it doesn't seem like the end of the world. But actually, from a lawyer's perspective, is that you need to have instructions from the bank, or certainly have bank solicitors if they're going to use third party representation in the background relatively early on, so that you know what you're going to need in that sale contract. The risk is, and this is where I suppose comes up to our earlier point about commercial solicitors, is you'll have some solicitors who won't negotiate an SPA until they've got bank instructions.
No, which you're right, and often, as you say, without that bank instruction, there are other things which then affect the transaction from the buyer's point of view, which ultimately has a knock-on effect on the seller when it comes to the conditions precedent as well, which again can be a whole other issue if it's not dealt with at the time.
Yeah. And of course, it comes to the earlier point about entities and all that kind of jazz. Is
Yeah.
They just need to make sure that the bank is on board. And one of the earlier processes, which is probably, I'd say, one of the bigger hurdles to get over in the finance process, is the bank valuation. That is. I mean,
Yeah.
if I was to say what is the most common issue that makes deals fall over, I think I would put bank valuation right up there.
Yeah, I think you're right. I think that because I think it's got better. But it's always one of the things that I think in any transaction that I get more nervous of as the sort of deal goes on, and it's making sure that you get that valuation as soon as you can. And I suppose, as you say, that comes down to the speed of a transaction. And actually, if you're buying through an independent buyer, it shouldn't take that long to get instruction from the bank. It's where that process then gets delayed further and further and further, and solicitors aren't doing what they should be doing. That process, the finance sort of strand, isn't where it should be, which means that you get so far into the transaction by the time the valuation has been done, and if there is a discrepancy,
then to use an expression that one of our ex-corporate buyers used to use is that then you've got the vendor on the hook.
Yeah.
So the vendors, if you like psychologically already spent the money from the practice sale proceeds,
Yeah,
which
completely.
then means that they feel more obligated to accept the reduced offer, which they shouldn't have accepted.
Yeah.
And I suppose it comes down to marketing process as well, is the fact that if the practice wasn't marketed thoroughly enough, or you haven't got the right comparable data
Yeah.
to support a bank valuation, then you're far more likely to have issues. Don't get me wrong, we have our issues with bank valuation, but I
Yeah.
think we have them far less because we sell over 120 practices a year, we have access to a stream of comparable data, which means that if a valuation does come in inaccurately, in our opinion,
Yeah.
is that we can challenge it. And again, it comes down to clarity on prospectuses again, is the
Yeah.
particulars we put together are quite clear on the estimations and the approximations that we've made, so that it's quite easy for a bank valuer to work with.
Understand.
Whereas I think sometimes where you don't have that relationship with bank valuers, or where you have maybe an agent who doesn't want to release comparable data or doesn't want to justify their own valuation,
Yeah.
is that you can end up, the negotiation becomes a lot harder.
Yeah, it can, and also, in terms of when you look at it from a buyer's point of view, or from if you take it back a small step, is that when you're looking at to accept an offer, if you'll accept an offer significantly above the asking price, it's important that the buyer is aware that there's a good chance that the valuation is going to come back less. I think that's another point which almost has to be outlined from the outset, that if you are looking to accept, and as you know, in our process, because we offer the bidding, the open bidding process, it's often that a practice can go above asking price. Arguably only probably maybe 5 or 10%, but that 5 or 10% is a big chunk when you're looking at practices above, £1-2 million. And it's making sure that the buyer is fully aware of that, and that's a big point at that stage as well, because the valuation is going to come back lower.
Yeah. But of course, sometimes it's not the finance. Sometimes actually, again, people find this weird. Is the other big delay in practice sales is the vendors themselves. Because they don't produce the due diligence information. I target most of the clients I personally work with for about a month to produce a full suite of due diligence information. And if you're not producing it within that month, then you're not allowing adequate time for your purchaser solicitor to review that information. And again, going back to what we were saying about advisors, is that you also want to make sure that your solicitor reviews it before it goes across. The amount of solicitors who just willy-nilly send information as it's received across to the purchaser without checking whether it's something that should be disclosed, or whether it's something that's even relevant or even indexed, so that the purchaser solicitor can actually review it easily, is that they need to produce that information. And of course, if it's poor quality, the amount of people who go through a due diligence questionnaire and put to follow, which is fine. You're not going to have every document to hand. But what you don't want is a DD questionnaire with 168 to follows, because then you haven't really done your due diligence.
Well, no. And I actually had one where he needed to list all the GDC numbers for his staff, and he just listed the GDC website with their names.
Oh, really?
And just said, go find it yourself. Which ultimately doesn't help anyone. But and also, I think I remember in that particular case, is he answered each question in an email, which meant that you had probably 120 odd emails coming through with an answer to each question, which you never knew really which question he was actually answering.
But then it's the same vendors who'll turn around and say, I've already answered this question.
Or why is my transaction not moving, or for what, so I think the DD process is probably quite a big one, and actually again dictates the speed of a deal. And I find particularly, again, it comes down to pre-sale probably a bit as well, is making sure that you're preparing for the due diligence process, because I think that's that can cause its own problems, particularly if you've got a solicitor on the other side which isn't as commercially aware or as responsive as what they should be.
Well, also the due diligence, forms the basis of the sale contract in a lot of contexts. It's okay, it probably forms the basis of the indemnities and warranties section, but that's probably the section of the contract where the solicitors are most likely to have to negotiate hard. And sometimes it's right to give an indemnity. We obviously spoke about the tax avoidance issues earlier on, and in those kind of issues, it is perfectly equitable to provide someone with an indemnity. The difference with an indemnity is there's no question, of course, whether that there is recourse. Whereas with a warranty, you often have de minimis levels where actually the amount of claims against those warranties needs to get over a certain threshold before your buyer can have recourse. Which is why often purchasers prefer indemnities. Vendors prefer warranties. So I think it's quite important. People underestimate, how important sometimes some of the due diligence is, and also the fact that even if your purchaser is happy not to receive a document, it doesn't necessarily mean to say that their bank is.
Of course, and I think that comes down to is getting the right advice from the right people, isn't it? And if you're being ill-advised through that process, or you haven't got two balanced solicitors, then equally you're going to run into problems.
And again, a lot of the solicitors who are used to working together regularly often have agreements as to what due diligence they will ask for and what due diligence they won't ask for. So again, try and decrease some of the timescales that they're working towards.
Well, I notice a massive difference in those transactions. The transaction is just a lot smoother. You don't find that you're arguing over an email for the next 3 weeks over a point which actually could have been resolved pre that, because they understand that actually they've got a general understanding. It's not
and again, they're thinking about the whole transaction. So going back to your point about warranties, is that you can give a load of warranties, and the vendor solicitor is saying, "Oh, well, don't worry too much about that because we can disclose against that in the disclosure letter." And then what you find is there's an absolute humdinger of a disclosure in the disclosure letter that actually runs the risk of threatening the entire transaction, which wasn't disclosed at the outset. I've done recently where it was an NHS investigation. Is they didn't announce anything to do with the NHS investigation until we got to pretty much disclosure level stage. Now they knew about this NHS investigation back in sort of 2 months into the transaction, but they were of the belief that if they disclosed it at the 11th hour, then actually they might get away with it, or the purchaser would be so keen to proceed that they would just crack on.
It's often actually the opposite.
It's the opposite. Threatened transaction, loads of wasted fees, loads of wasted time. Then you've got a practice going back to market, which also does impede value by itself. And so, disclosure letters are of course really, really important, but what you don't want is you don't want to be putting, massive disclosures in your disclosure letter, which really should have been disclosed
early on
at the outset. Which of course has to be balanced with the whole caveat emptor attitude to it. But things like NHS investigations, patient complaints
should be outlaid early on.
Should be outlaid
rather than
at the outset.
And I suppose it comes down to various other issues. I mean, lease issues. If you've got an external landlord, we spoke briefly earlier about some of the pre-sale stuff that can cause the issue. But equally, if a third-party solicitor or their representation isn't instructed early on, again, you can come across all sorts of problems. And they're in no rush. They're often in no rush to get the lease through. So I find that actually it's quite important to make sure that everyone else is on board and almost all your stakeholders are in the process early on, rather than getting to the 11th hour and the lease hasn't been agreed, or they've got a third party solicitor that isn't in their interest to get things done quickly.
No, I think you're right. And I think sometimes as well is that people see the local area teams as the enemy, whereas actually you need the local area team on side during the sale process more often than not. Okay, the partnership routes are fairly well provided now and are fairly well written, but actually if you're not working with your LAT, the chances are they're not going to want to work with you, and accordingly the timescales in which they process the documents they will be significantly slower. And it's all fine and dandy to say, oh well, actually it says in the contract they have to do this within 28 days, but what are you going to do if they don't?
No, completely. I know, and as you quite rightly point out, actually there's parts of the process which is far easier. If you're going into a partnership route, it's probably a little bit quicker, or obviously if you're a limited company. But if you've got a change of control clause in the company and you need the discretion from the LAT, then again you really need them on side in order to give you that go ahead to change shareholders, because otherwise again you can come across problems.
But of course due diligence should be twofold, and we encourage vendors to do due diligence on buyers as well, because often how many times have we had a cash buyer who's had their offer accepted to get 3 weeks post heads of terms to find they're borrowing money from a bank, and yet the incentive to accept the offer from the cash buyer was that they can do a faster transaction. And in reality, they're not going to do a faster transaction because they're not going to complete until they've got the notes from the bank. And don't get me wrong, of course you would always want proof of cash, and often these buyers are the stronger buyers, but you want to accept on the basis of the understanding that do they intend on using that cash? Because if they don't intend on using it, then actually there may not be the same level of advantage of someone who has a very, very chunky deposit who may have given you a better kind of overall deal in that sense.
Or equally owned by a private equity firm or VC, where they don't need, they've got a board to go to for approval. They're not having to draw down in the same way. It's got to be accepted in the same light as if you were going to, one of the banks.
Exactly. And buyers who are wishy-washy. So you get people who come to us with a letter that from a bank, and as the key catchphrase, isn't it? We've got a strong appetite to lend. Which means absolutely
a lot.
Sweet. There is nothing in there that says that this person is definitely going to get the money. It's not a credit-backed offer. Yeah. So again, I suppose it's the importance of understanding the difference between a generalist letter from a bank saying they're happy to lend someone the money against having a credit-backed offer.
Yeah, of course, and equally the banks can't make a decision until they've gone through that process and gone through credit.
Exactly. So you want to make sure that the bank manager has done his diligence on your practice.
Yeah, of course.
Because actually, there's loads of people, and I've seen them, haven't they? They walk around from IFAs now saying with this certificate, saying I can buy a practice for up to £1 million. Well, yeah, they could buy a practice up to £1 million as long as the debt serviceability is right. Yeah. But actually, sometimes with some of these practices, the debt serviceability isn't right. And even though he may have his, say, £200,000 cash deposit, he may struggle to buy that practice for £600,000 because actually the serviceability and the underlying profitability in a given practice isn't right.
And sometimes the banks have conditions as well that against what they're prepared to lend against. So it has to be a particular type of practice, a percentage of NHS, a percentage of private, which again can cause issues.
Well, it's funny you mention NHS because, of course, the other aspect that we've seen is buyers who are very good private dentists who want to go out and buy a practice, but they buy a practice where it's got an NHS contract. The challenge being is that they haven't worked in NHS for, say, 10 years, and they haven't got a performer number. So then they've got to go through the performer number registration process in order to work in the practice. And whilst you can be a party to an NHS contract without a performer number, your bank is probably going to want to insist that you do have a performer number so that you don't buying a practice where you can't deliver a proportion of income.
Completely. And I think you're right in that I think there's the buyers they're slightly more scrutinised. But there's more due diligence done on buyers now, even from a bank's point of view. It's all about the CV. Historically, 30 years ago, you might have been able to go to the bank and get 30 grand just like that to buy a practice. Whereas now...
30 grand? That's cheap practice.
30 grand. Well, they're all valued a lot less back then. Or 30% of gross or whatever it may be. Whereas nowadays, it's not like that. It is about their CV, it's about experience, it's about what they've been doing historically and what they're qualified to do. And
so what's your view on buyers who want to go into a practice and work there before the practice sale is actually completed?
I think that's a grey area, to be honest. I mean, I've had that in a number of cases, but I think one of the key things is that I'd say you don't want to put people off the transaction, but equally it has, there is a risk where you get somebody working in the practice prior to sale that for whatever reason they may find that it's not for them. And actually, can you really tell within such a short space of time as to whether that practice is the right acquisition or not? And I think that it in my opinion, opens a can of worms, which I probably wouldn't advise.
I think my opinion is slightly stronger on it, in the sense of the fact that I really advise vendors against it. Because I think there's always that kind of the analogy I always use, it's always a bit like the first day of a new job. If you're leading into a first day of a new job, you're excited, you can't wait to start, you may be getting a bit of a pay rise, blah, blah, blah. But then you come out the first day and you realise you've got a hell of a lot to learn. You're not with all your old mates from your old practice. As you say, it's overwhelming. So you don't have the same love for it that you did. And that's the point, is that if that goes on for maybe 2 or 3 days, or maybe Gail on reception isn't quite as friendly as you would have hoped she would be, you can find deals starting to falter, because then a buyer starts to look for reasons why they don't want to buy a practice, and then your deal can fall.
And equally, they're inexperienced practice owners, I suppose. So they start looking at it slightly differently. They're not looking at it from an associate point of view. They're looking at it from I'm about to buy this practice point of view.
Or worse still, they realise the amount of work a principal does,
and it gets put off.
And then they realise they don't want to do that.
Yeah.
Yet you've wasted 5 months of your life waiting for Mr. Dentist to buy your practice, who's now whimsically decided that actually he doesn't think he wants to be a principal. The reality is it's probably not that hard work, so it's not to put buyers off, but it's just that they're not used to doing that job yet. Some of the issues don't stop at the time a practice sale completes, because obviously most people, well, not most, that's probably unfair, a lot of people we act for now stay on post-completion.
Yeah, of course.
And how does that relationship work? And I don't know about you, but the guys I still see wandering around the trade shows and the trade conferences, I'd say it's a real 50-50 mix. 50% of people love it, best thing they've ever done. You know, we sold a practice down in the southwest to Oasis a number of years ago, and the solicitor who did the transaction with me saw the guy in B&Q and said it was the best thing he's ever done. Loves it, lost all the stress from the transaction, gone back in as an associate, really enjoying his clinical work. Whereas conversely, I can see someone else at a trade show who will turn around and say, actually, it's the worst thing they've ever done. And it doesn't necessarily a reflection on the practice owner or the buyers. Sometimes it's a psychology, I think.
I think that's what it is. I had a guy who I sold a big ortho practice to, and he sold to one of the big groups. He said I saw him the same thing actually at a trade show, and actually funny if we've got a testimony from him as well. But he said actually, you know, it just isn't for me working for somebody else. Is that actually they're doing nothing wrong? They provided me with everything I need, materials, the labs, everything's actually running smoothly. But I'm just not my own boss. I am answering to somebody else. And he said that there is a psychology there which does exist, which he said not that he doesn't enjoy it. I think his kind of words were, I'm towards the end of my career, I'll deal with it.
Yeah. And I think there's a fine line though, isn't there, in the sense of the fact that some people have the personalities where they can go into a practice and they can become the associate again. Some people don't have those personalities, is they still want to run the place, or they find that actually the staff
still treat them.
Still treat them as they run the place. And that's one of the things I tend to advise a lot of my vendors who are staying on, is that really, you know, get the first couple of weeks out of the way, do the handover, but then disappear for two or three weeks. Go on holiday, don't be at the practice, and let the staff adjust to the new owner, and let them start going to him or her with the issues of the day or for questions about the rota and stuff like that. Because otherwise, if you don't do that and you stick around for a good sort of 3 months for completion, he's then bedded into the practice, you're still in the practice, and actually nothing shifts. There's no moving goalposts. They still continue to come to you, and then you get the gripe of, oh well, I've sold it, but I still feel like I run it for him.
And to be fair, actually, on the other side of that, I'd say I think 90% of the time that doesn't work for a lot of sellers. But again, I had another one where I had a conversation with who was a similar thing, but he found that he was still the front man, so people were still coming to him with the issues. And actually, he said he enjoyed it. Oddly, he said that even though I don't have to do all the backroom stuff behind it, I'm the spokesperson, I'm the person they come to, and it gives me this sense of, even though I've cashed in, I'm still got this family.
But he can pick and choose.
He can pick and choose, and I've got this sort of family feel about. But the practice was a small practice, so he enjoyed, say small, but smallish. And that was, he enjoyed that side of it, oddly. But I suppose it's getting the right mix, isn't it?
And I suppose the thing I found quite interesting, the amount of buyers who don't prepare to take over a practice, which sounds really odd, but the people who don't order their PDQ machine so they can actually take patient payments immediately after completion, or the people that spend every last penny on buying the practice but don't give any thought to the idea that actually maybe 10 days after completion the staff are going to need to be paid, the lab bills are coming in, and they don't have access to liquid cash to actually run the business, and they haven't owned the business for a long enough period of time yet to accumulate cash reserves.
Of course.
Which again is why often, when we're talking to our finance team, talking to people, they're talking to them about potentially overdraft, because whilst some people don't live in their overdrafts and they never have done, is that actually there is that short space of time, I think, post completion where you need to say to them, look, have you actually got a month's worth of working capital to run the business, just in case there is an issue? Because we have had it where NHS send the money to the old principal's bank account, and if he's enjoying his money, you've just paid him out in Mauritius, you're not going to get it. And
I suppose that's where you've got the added advantage of an NHS contract. You can still have those problems, even though you're guaranteed that cash flow. Obviously private practices haven't got that, so it's important to make sure, as you say, that you have got the working capital there. To balance it. And
the handover is key as well, because there's obviously the new incumbent purchaser will need to probably work in the practice full time and have a full time patient list in order to ensure that they can meet the covenants of their loan. But actually it's how that's communicated to the patients. I've seen people who've gone in really, really gung-ho and written to all the patients telling them that Dr. Bloggs has resigned and they're going to be their new dentist, but it's okay because they do facial aesthetics and they do implants and they do all this stuff. They frighten off the patients.
And equally, it looks like that they're just there to make some money.
Yeah.
Rather than there for the patient, and I think that's quite a key point. But yeah, it's how that transition is managed that's
so
crucial,
so important.
Well, that concludes our webinar for today. I hope you found the discussion useful. There are some contact details on the last slide.